This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade Forex Report with Scott Norse.
Good afternoon, traders. Scott Norse here, wrapping up the week. It is Friday, July 25th, 2008. Well, the greenback had one of the best weeks we have seen in a long time, thanks at least in part to a decline in crude oil. The dollar advanced a few hundred pips against most of its counterparts in the last 4 days after getting off to a rocky start. The euro and several other currencies tried to make new highs on the dollar out of the gate, but sharp drops in oil and gold on Tuesday turned the tone 180 degrees. The biggest chunk of the buck's gains came on Tuesday and Wednesday amid the declining commodity prices and weak numbers from the Eurozone and UK. Additionally, the RBNZ cut interest rates. With no U.S. data due until yesterday, the dollar was free to run. While yesterday's jobless claims and existing home sales numbers both came in poorly, the dollar took the news in stride. Today we made up for the disappointing figures with big gains in durable goods orders and new home sales. It seems as though the fundamentals could be slowly shifting in the dollar's favor. On the technical front, we have been very confident in the dollar this week. We recently created some clear bottoming signals for the dollar and several pairs which were cemented this week. For example, the euro-dollar formed a double top around 160 earlier this month. While we saw this as a sell signal, this Monday's failed rally at 159.50 gave further credence to that pattern. We now have lower highs on the daily chart to lead us lower. The same holds true for pairs such as the Aussie dollar. The dollar Swiss seems to be forming an inverse head and shoulders, which is a signal for further upside potential. Overall, we're feeling rather optimistic about these signals. A little more work early on next week from the dollar, and we could see buying pressure really intensify. Now to the big picture. The big picture is starting to look better for the dollar and the U.S. in general. We hate to get too excited about it when oil just drops below $125 a barrel, but a $20 drop from the highs is certainly worth talking about. The decline in crude prices has clearly boosted the dollar, and even stocks have found their footing. Meanwhile, as the global economy shows signs of sharp slowing, the greenback doesn't look so bad. We still have a tough road ahead in the U.S., but we feel the worst has been priced in. This is not to say the buck couldn't slip again at some point, but the focus is now more on other currencies trading near multi-year highs with underlying economies that are turning lower in a hurry. Additionally, the recent fall in oil may be one that has some lasting potential. Oil supplies look steady, and demand destruction here and abroad is becoming increasingly evident. We believe there's plenty of room for crude to fall, perhaps below $100 a barrel, before the end of the year. That said, we're expecting the buck to make further upside attempts in coming weeks. We will keep an eye on all pertinent U.S. data, but are especially interested in other G7 numbers. Until Monday, have a wonderful weekend. Take care.